Silver just had one of the most violent crashes in modern market history, from an all-time high of $121 to $73 in less than 4 months. That's a 40% collapse. Investors are panicking. Headlines are screaming, "Bubble burst." Social media is full of "I told you so" posts. But here's what nobody is telling you. The smartest money on earth is quietly buying silver right now. Central banks, hedge funds, long-term institutional investors. They know something the headlines are hiding, and in the next 13 minutes, I'm going to show you exactly what that is. In this video, I'll break down 5 critical things. Number 1, the real reason silver crashed, and it's not what the news is telling you. Number 2, why this crash is actually identical to one that happened in 2011, and what happened next will shock you. Number 3, the 3 forces that are still pushing silver higher despite this drop. Number 4, what major Wall Street banks are predicting right now. Some targets are insane. And number 5, if you're going to buy silver during this crash, exactly how to do it without making the mistakes 90% of investors make. The third point is going to change how you see this entire crash. Stick around. Let me walk you through exactly what happened, because the timeline matters. January 29, 2026. Silver hit an all-time high of $121.64 an ounce, the biggest rally in modern history. Hedge funds were piling in. Retail investors were going all in. Social media was screaming silver to 200. Then on January 30th, everything changed. Silver suffered a 35% single-day drop, the largest one-day decline on record. It closed at $85, down from $115 at the open. Gold and silver combined erased roughly $7 trillion in market value in a single session. But here's the strange part. The fundamentals didn't change. Inflation didn't suddenly drop. Industrial demand didn't disappear. Supply deficits didn't get fixed overnight. So what really happened? Let me show you. The silver crash had nothing to do with silver itself. It was a positioning unwind, pure and simple. Here's what that means in plain English. For months, hedge funds and traders had built up massive leveraged positions in silver futures. They were borrowing money to bet on higher prices. The paper silver market is 21 times larger than the physical silver market. That's right. There's 21 ounces of paper silver for every ounce of physical silver. This is called paper leverage, and it makes the silver market extremely vulnerable to sudden moves. On January 30th, the CME Group raised margin requirements on silver futures. This forced traders to either put up more cash or close their positions. Most chose to close. The selling cascaded, algorithms kicked in, liquidations triggered more liquidations. In hours, silver lost decades of gains. But notice what didn't change. Industrial demand for silver, still growing. Supply deficit, still at record levels. 6 consecutive years of deficit. Central bank gold and silver buying, still accelerating. Geopolitical tensions, still elevated. This is critical to understand. The crash was a mechanical event, not a fundamental shift. And this is exactly why smart money is buying right now. Now here's where it gets fascinating. This exact scenario happened before, April 2011. Silver was approaching $50 an ounce. Then the CME raised margin requirements multiple times, by more than 80% within weeks. Forced liquidations were severe. Silver fell more than 30% in just over a month. Sound familiar? Now here's the key question. What happened after? In 2011, the macro environment had changed. The Fed was ending quantitative easing. Real interest rates were rising. The dollar was strengthening. The bull market was actually ending. The crash just accelerated the inevitable. So is 2026 the same as 2011? Look at the differences. Inflation is still hot at 3.8%. The Fed has not pivoted to positive real rates. Central banks have been net buyers of gold and silver for 15 consecutive years. The U.S. national debt is now $39 trillion, up from $14 trillion in 2011. Industrial demand from solar, EVs, and AI is structural and growing. The supply deficit is at record levels. This is not 2011. The macro forces that drove this bull market are not just intact, they are stronger. That's why legendary trader Peter Brandt, who predicted the January crash, turned bullish after it. He wrote, "2026 is not 2011. The 2011 rally was destined to return to the teens, not this time. History rhymes. It doesn't repeat. So if the crash was just positioning, what forces are still driving silver higher? 3 major ones. Force number 1. The supply crisis is real and growing. The Silver Institute's 2026 World Silver Survey projects a sixth consecutive annual deficit of 46 million ounces. Cumulative drawdowns since 2021 have reached 762 million ounces. Physical silver inventories in COMEX vaults dropped 70 to 80% between 2024 and early 2026. The world's most important silver storage facility is being drained. Force number 2. Industrial demand is structural. Silver is no longer just a precious metal. It's the most important industrial metal in modern technology. Solar panels, electric vehicles, AI data centers, medical equipment. Every gigawatt of solar power needs millions of ounces of silver. China alone added 207 tons of physical silver demand in Q1 2026, the highest quarterly total in their history. Force number 3, monetary fragmentation. The dollar has weakened 10% in recent months, the most divided Federal Reserve in 34 years. A new Fed chair incoming. Central banks are continuing to buy gold and silver as alternatives to the dollar. Bar and coin investment for gold jumped 42% in Q1. None of these forces have reversed. They have accelerated. Now let me show you what major institutions are predicting for silver. Even after the crash, JP Morgan now forecasts gold at $6,300 an ounce by the end of 2026, a 30% gain from current levels. If gold goes there, silver typically outperforms by a factor of 2 to 3 times. Bank of America has issued a long-term silver target between $135 and $309 per ounce. $309. From the current 73. That's a potential 300% move. Goldsilver.com has a bull case target of $175 and above. UBS continues to raise targets after each rally. Now let me give you some perspective. Gold hit $5,405 in January 2026. The gold to silver ratio is now sitting around 55 to 1. Historically, during silver bull markets, this ratio compresses to 31 to 1 or lower. If gold stays at current levels and the ratio normalizes, silver would need to be at $175 just to catch up. This isn't fantasy math, this is historical pattern recognition. And the same institutions that have been right about this bull market all along are saying we're nowhere near the top. So if you're convinced silver has more upside, how do you actually buy it without making the mistakes that 90% of investors make? Let me give you 5 rules. Rule number 1, never go all in on volatile assets. Silver moves 10 to 20% in a single day during crashes. Position sizing is everything. Most financial advisors recommend 5 to 15% of your portfolio in precious metals total, not 50%, not 100%. This is insurance against currency debasement, not a lottery ticket. Rule number 2, use dollar cost averaging. Don't try to time the bottom. Even professional traders fail at this. Instead, buy a fixed dollar amount each week or month. If silver drops, you get more. If it rises, you have momentum. This removes emotion from the equation. Rule number 3, choose your vehicle wisely. If you want direct ownership, buy physical silver coins or bars, American Silver Eagles, Canadian Maple Leafs, generic rounds, from trusted dealers. If you want easy trading, SLV is the largest silver ETF, highly liquid. If you want physical-backed ETFs, PSLV from Sprott, each share backed by real silver in vaults. If you want leverage, AGQ is a 2 times leveraged silver ETF, higher risk, higher potential reward. If you want maximum upside, silver mining stocks, companies like Wheaton Precious Metals or First Majestic Silver. Even more volatile, but biggest leverage to silver prices. Rule number 4, set position limits. Decide before you buy how much you're willing to lose if silver drops another 30%. Then never exceed that. Rule number 5, think in years, not days. The silver thesis is multi-year. Quarterly volatility is the price you pay for long-term gains. Investors who panic sell during crashes are the ones who miss the next leg up. So let me bring this all together. Silver crashed 40% from its January high. The cause was positioning, not fundamentals. The supply deficit is at record levels. Industrial demand is structural and growing. Central banks are still buying. Wall Street targets range from $135 to $309. Smart money is accumulating during this weakness. Now here's the truth nobody wants to say. I cannot tell you whether silver bottoms at 70 or 62 or even 55. Short-term price action is unpredictable. What I can tell you is this: if you believe in the long-term thesis, volatility creates opportunity. The investors who built generational wealth in precious metals weren't the ones who timed the perfect bottom. They were the ones who consistently bought during weakness, when the headlines were screaming bubble burst, when the social media gurus were calling for collapse, when fear dominated greed. That's when fortunes were made. Let me give you the bottom line. The silver crash was mechanical, not fundamental. This is not 2011. The macro environment is completely different. Three major forces are still active and accelerating. Wall Street institutional targets remain bullish despite the crash. Smart strategies involve dollar-cost averaging, position sizing, and long-term thinking. This isn't a get-rich-quick play. This is wealth preservation and asymmetric upside. In my next video, I'm breaking down something even more important. The gold-to-silver ratio just compressed from 62 to 55 in a single week, one of the fastest moves in years. I'll show you exactly what this signal means and how to use it for maximum returns. You don't want to miss it. Hit subscribe so YouTube notifies you when it drops. Before you go, I want to hear from you. Are you buying this silver crash, or are you waiting for further confirmation? Drop a comment below. I read every single one. If this video helped you understand what's really happening in the silver market, smash that like button. It helps me create more research like this. And if you're not subscribed yet, what are you waiting for? We break down precious metals and investment opportunities every week. This is not financial advice. Always do your own research before making any investment decisions. Stay informed, stay disciplined, and stack smart.